Welcome everyone to this small caps webinar presentation. My name is Tim McGowan and I'm your host for today. Tonight, and it is a 6 p.m. start, that's because our presenter is in Geneva. So tonight we're joined by Mr. Alex Scanlon, who is the Managing Director and CEO of Barton Gold. The company has an ASX code of BGD and a market cap of around $57 million. Now, the format for tonight is a brief presentation, the focus of which is the Tunkillia scoping study. If you've got any questions, please enter them in the Q&A box at the bottom of your screen. We will ask questions of Alex at the halfway mark of the presentation and also at the end of the presentation. So please ask questions. Alex, thanks for your time. Over to you.
Thank you, Tim. And thank you very much, everyone, for joining us today here. I will share my screen here and bring up our presentation. If you would like a copy of this, this is available on the ASX platform and also, of course, our website. So the big news for us here, and the reason we're here sort of having a catch up, is really an opportunity for people to get a better understanding of a couple of really important steps we've taken forward in the past 3 months, including and sort of culminating in the latest publication of an initial scoping study for the Tunkillia gold project. As Tim mentioned, we'll have a couple of opportunities for Q&A, so please do ask questions if you have them. We like getting into these things. We like discussing everything from the deep technical detail to the larger macro thesis here. But what I'll do is I'll take us all through the sort of updated or expanded corporate presentation, and then we'll get into those questions. So before we jump into the presentation, for those of you who have not seen this before, the cover image here is not a stock image. That's actually a picture of our Perseverance open pit mine at our Tunkillia project, and that is important for a few different reasons, which we'll come to during the presentation. Of course, we have our standard important notices and disclaimers here, which you can read in due course. But stepping up to sort of the big picture here, to recap what we're doing and what our strategy is as Barton Gold. We are a pure play gold developer focused on South Australia. And we are focused on essentially renewing an historical gold region in the central Gawler Craton of South Australia. So South Australia is a very interesting state geologically, but also in terms of its gold history. And there's a few different ways of looking at that. But for one, South Australia as a state is about 50% covered by the Gawler Craton. So you have this sort of globally renowned geological domain. And in the very center of that, we have some very, very well-known copper projects. BHP's Olympic Dam, which is predominantly copper and uranium, globally known, perhaps to a slightly lesser extent, but certainly well known if you're in Australia, are the Carrapateena and Prominent Hill deposits that run sort of from the southeast to the northwest along this IOCG province. And BHP has now consolidated all 3 of those projects by acquiring Oz Minerals. But just to the west of those projects and running sort of parallel with the IOCG belt, there is a shallower historical gold belt, and it's sometimes called the Central Gawler Gold Province. And this is a gold province that has a 130-year history of shallow, historical, high-grade gold production, but has never really been aggregated or agglomerated and then sort of systematically built to a much larger gold province. This is where South Australia had its gold rush in 1893 at our Tunkillia project. And it had sort of a second gold rush in 1996 when both the Challenger underground mine and the Tunkillia gold project, both of which we also own, were both discovered within a few months of one another. And then the gold price crashed in the late 1990s and everybody sort of ceased gold investment. Now, from our standpoint, that's quite interesting because there was a huge amount of investment made in the state in sort of shallow initial works in the region. And then about 10 years later, if you recall sort of gold price history, the gold price came back to $800 and $900 per ounce in 2007, 8, and 9, and everybody went back into gold investment. But people tend to go where muscle memory takes them. So they went back to the eastern margins of Queensland. They went back to Western Australia. They did not really come back to South Australia. Instead, investment in South Australia has really been focused historically on copper and uranium. And this is why we get such a really large disparity between the gold endowment or the gold wealth in South Australia, being about 25% of Australia's known gold resources, and South Australia's actual gold production or contribution to Australian gold production, which is only about 2.5%, which is a very large disparity. We saw that as a very significant opportunity. We essentially have gone into the Central Gawler Craton and acquired every significant historical exploration and production asset. We acquired the only gold mill in the region. And the strategy there is, rather than rushing that mill back into small scale operations, as had been the case previously, we wanted to step back and invest some pretty serious money in doing regional geological work to build up our understanding of the local, sub-regional, and regional geology. It is highly variable between projects, but that is also actually presents an interesting opportunity. We wanted to build that up and then figure out how we can turn this all on in a staged, lower cost and lower risk development model, leveraging our existing fully permitted, fully licensed mill, and then sequentially expanding into larger and larger operations and developing additional infrastructure to create a leading domain domain gold producer, or a gold producer is essentially leading an entire region in the center of the state. So for us, there's a three-stage strategy there. One, we wanted to establish large-scale bulk open pit mineralization, something that's actually a real company maker and can carry the project for long term. That is where we've been focused on our Tunkillia project. Two, we then wanted to focus on complementary high-grade mineralization, so something that can blend into Tunkillia and perhaps improve the economics of that on an annual basis, but also something that can then go through our existing mill if possible. And that's where that sort of third string of the strategy comes in. That is leverage that existing infrastructure to start this lower cost, lower risk, lower dilution stage development. So we've really been methodically chewing through this strategy. We've been publicly listed for 3 years now. We have crossed many bridges in that time. We've done an incredible amount of work. This has included 4 resource upgrades over the past 16 to 18 months alone, as we've seen a lot of our theory convert into new gold zones, converting into new resources. And we have just published a new initial scoping study for the Tunkillia project, which outlines a pretty competitive 130,000 ounce per annum operation. And that's sort of a starting point for us. And we'll focus on that today as part of this presentation. And one of the key things for us is, with everything that we are doing, we really do focus on positioning ourselves, looking sort of 12 and 24 months ahead. So we always make sure that we're well capitalized in advance of what we're doing. We also focus on asset monetization, so we generate cash from our assets. So we're in a very good position right now with about $10 million worth of cash to continue sort of operating at pace and advancing these assets at a pretty impressive speed. Just a quick note on the capital structure. Barton Gold is a pretty simple company in terms of its capital structure. We have about 219 million shares on issue. That today makes us about a $55 million company in Australian dollar terms, or with about $10 million in cash, about a $45 million enterprise value. So we have no debt, and we have really, I think, performed quite well over the past couple of years. As we probably all know, it's been a fairly difficult market in gold equities. A lot of just general disinterest has seen a lot of sort of equities trending sideways and down. We've done a very good job of attracting interest and support. We've seen a huge expansion of our share register on market. And we do this really with just sort of consistent, reliable progress that is, I guess that's consistent and cost efficient. We've been able to achieve a lot with a relatively small amount of capital. And that has attracted the attention of both public retail shareholders as well as a strong contingent of institutional investors who really specialize in early to medium stage asset development and backing quality teams to deliver strong outcomes. So we have performed very, very well. We put ourselves up against the gold price itself, and we track ourselves against an index of peers and even the VanEck Junior Producers Index, which is, of course, made up of several billion-dollar companies. And we've actually performed quite well relative to those. So something that we're quite proud of, and I think it really comes back to the type of consistent progress we're discussing today. We can't go past the capital structure discussion without talking about human capital. And this is the most important capital that we have. And we have focused very, very carefully on building a very high quality team that is focused on doing something really significant in South Australia. So we have put together a team quite carefully over the past few years, which together probably has the better part of 300 years of experience just in the senior leadership ranks, exploring for permitting, financing, developing, and operating major mining assets. And that also comes with a particularly strong pedigree or focus in South Australia and gold. Gold, obviously important to us. We're a gold-focused company, but a South Australia sort of background, pedigree, and focus is also really important. So our entire team, minus one director, are based in Adelaide. We're built predominantly of quite passionate South Australians. I am a transplant to South Australia. And we've got a group of people here who have a lot of experience, a lot of knowledge, a lot of sort of domain expertise and relationships who are very passionate about building a significant gold producer for the state of South Australia. And in a sense, we are essentially building a team that's sort of in pursuit of our broader mission, which is to become South Australia's leading independent gold producer. So something that's very South Australian focused. And we would effectively, we would be sort of reconstituting the primary gold industry of the state by doing this. So when we go to the sort of the map here and looking at the map of our assets, there's a lot going on in this image, but I'll sort of deconstruct this a little bit. We have sort of three key project areas: Tarcoola right in the middle, Tunkillia's bottom right, and then sort of the Challenger deposit area and Central Gawler Mill area top left. And what you can see in the map here is these projects are located along the Stuart Highway. So that Stuart Highway sort of comes up into the right-hand side of this image here. And this is the highway that runs from Adelaide all the way up to Alice Springs. And to the right-hand side of this is where BHP have Carrapateena, Olympic Dam, and Prominent Hill. But as you come to the left side of the highway, the same basin, the same mineralized basin that hosts that sort of deep coppery mineralization on the east side in the AISC province comes up and gets shallower, and it becomes so deep and coppery to shallow and goldy. And this is where we have focused on consolidating all of this ground. So again, our real strategy here is to scale the geology, but we're also really focused on open pit mineralization as a starting point. And the reason for this is that open pit mineralization is faster, easier, cheaper, and safer to explore for, to develop, and to operate. So what we're really looking for here is bulk open pitable or shallow high-grade mineralization at our Tarcoola and our Tunkillia projects that we can combine over a long term into a really compelling project. And when we look at Tarcoola and Tunkillia together, we really do see them as one project. Now, I've drawn a few boxes here that I'll explain in a second, but Tarcoola and Tunkillia really are one project area. So between these two pieces of ground, we have over 3,000 square kilometers of ground. We have over 100 kilometers of major known structures. And on that structure, less than 2% of those structures, we already have about 1.5 million ounces that we built up. But these two pieces of ground are only about 70 or 75 kilometers apart. So in a practical standing, or as a practical matter, they really will operate together as satellites of one another from a logistical standpoint. So again, with that open pit focus and that idea that we wanted to create a big bulk base load first, something that can operate efficiently at scale, we really focused on accelerating resource development at Tunkillia. And so this is where we have now essentially sort of ticked that box by taking the Tunkillia project all the way from about 500,000 ounces up to 1.5 million ounces of JORC resources. And we crossed that threshold in March of this year and immediately started an initial scoping study at Tunkillia, really to sort of test the relationship between capital, operating cost, and mine design optimization. And now we're starting to look at how do we go into sort of strategy number 2? So how do we find higher grade enhancements? And that's where we look at Tarcoola. So Tarcoola is much more complex geology, but this is that sort of shallow high grade gold field that hosted South Australia's gold rush in 1893. So what we're looking for here is smaller bodies of mineralization that can act as blending feed for Tunkillia when we develop a new Tunkillia project. But then we can also go to that third point of our strategy and say, look, if we are successful in finding shallow high-grade mineralization at Tarcoola, it can not only be a blending feed for Tunkillia, but we can also use that as a stage 1 strategy, leveraging our existing central Gawler mill to start operations on a lower cost, lower risk basis and start producing 10, 20, 30, 40,000 ounces per annum and do that for a couple of years while we are fully permitting and getting Tunkillia ready for development. And in this manner of speaking, we're sort of crafting a big future, which in some ways represents a big challenge and a big financial wall to get over. But the combination of Tarcoola and our existing mill presents the opportunity to essentially build the step ladder to just neatly walk right over that wall. And that's really the strategy here, because we need far less capital to start operations with a fully permitted mining lease and a fully built existing mill than we would to build an entirely new project from scratch at Tunkillia. So it really is a stage strategy. And we believe if we do that right, we can do it with considerably lower cost, lower risk, and lower dilution to our shareholders. That is our objective. Again, we are strongly aligned as board and management. We own over 20% of the company. We want today's shareholders to own the majority of tomorrow's success. Now, when we think about why we're pursuing that strategy, so again, why the focus on bulk open pit? Why lead with Tunkillia? Why look towards years 5 to 10 or 5 to 15 instead of year to 5? The reason is that bulk open pit mining really does work better than everything, everywhere, all the time when it comes to mining. Whether you're talking about mining iron ore or coal or gold. In simple terms, if you can mine gold the same way that you mine open pit coal and big bulk operations, that's how you should mine it, because that is how you get to both capital and operating efficiencies of scale. And we profile a company called Capricorn Metals that I'm sure many of you will be familiar with. Capricorn is another ASX listed company. Ticker symbol is CMM, and they're about a 2 billion Australian dollar company. So this was a company that was working on their Karlawinda project around the time that we were looking at buying Tunkillia. And right around that, around 2015, they acquired the project as a sort of a 650,000 ounce asset. And then they worked on systematically scaling it out. So they went from about 650,000 ounces to 900,000 ounces to 1.1 and 1.3 and 1.5 million ounces. And then they really started focusing on, right, how do we develop this as a bulk efficient operation? And it was around this time that we were looking at the Tunkillia asset. And we started to see some similarities in the early data that we were looking at for Tunkillia, or the raw data that we were looking at for Tunkillia, and some of the scalability and sort of design features that were being considered at Karlawinda. Now, the Capricorn team then took Karlawinda and continued scaling it all the way up to about 2.2 million ounces currently. But it is currently 2.2 million ounce resource at about a 0.7 gram per ton grade. And this is something that people sort of conventionally, at least in Australia, would say, oh, gee, that's a really low grade deposit. That can't be that good. But Capricorn is focused on capital economies of scale, efficiency in operations, and efficiency in processing. And they are today one of the lowest cost gold producers in Australia. On a quarter-to-quarter basis, they are regularly the lowest cost gold producer. So they're producing about 120,000 ounces per annum of gold at an all-in sustaining cost of between $1,300 and $1,500 Australian per ounce. So it's really a very strong lesson in the efficiencies that you can get there. And what you can see if you look at sort of their timeline and then our timeline, which I've laid underneath it, is that we acquired our project around the end of 2019, early 2020. It was a 550,000 ounce asset. We then grew it to 965,000 ounces, and we went and found, or I should say confirmed, 5 more gold zones at that project. and then quickly grew it to 1.1 and 1.3 and 1.5 million ounces. So we've really followed exactly that same transition, at least in terms of growth in the project. And now we have stepped off also into studies looking at large scale development. So when we step into Tunkillia itself, what we're looking at here is a project map, a plan map, if you will, looking at the footprint of the area. And one of the really interesting features of this is when we acquired it, we actually acquired just this sort of very dark blue area, which is labeled the 223 deposit. That was the known resource footprint. But the majority of all the drilling that the majority of the drilling in the database that we acquired was drilled when the gold price was at $400 or below. So if gold is only so expensive, or if it is so cheap, you can't drill very deep. And what this did was it resulted in a really uneven base of mineralization and an inability or potentially unwillingness to invest in deeper holes to connect things. So we actually came in, we drilled through the center of the deposit to test our theory that there was a higher grade body of mineralization there. We also drilled to depth in a couple of rounds of drilling. And then we also went drilling along strike in areas that we thought would host repeats of bulk gold. And so we kind of rapidly expanded and demonstrated that the gold endowment here is much broader than previously understood. So we've had these 4 resource upgrades since October 2020. In the past year, we've added about 500,000 ounces during some of our work, and that's come at a cost of only about 15 Australian dollars per ounce on a true all-in basis. So drilling and assaying and lab work, logistics support, all of these things. So very, very cost competitive delineation of new gold resources. And this we have also now taken into an initial scoping study, which has mapped out a 130,000 ounce per annum operation at a pretty compelling all-in sustaining cost of capital. The key thing for us here is we think that there is actually considerable upside both in the existing deposit and the study as we've initially tested it, but also along strike here. So what we're looking at here is a short portion of strike. We have over 20 kilometers of additional untested strike length to the north and to the south of this deposit area. So we think that's pretty exciting. And when we start to look at the sort of characteristics of this deposit and the reason why we were attracted in the first instance, and the reason we've been getting more excited as we've moved along with more drilling, is there's some very attractive characteristics if we think about the geometry of the geology, because the ability to mine a bulk open pit efficiently, or the ability to bulk an open pit and actually achieve these economies of scale, depends very much upon the geometry of what you are mining. So simpler shapes, bigger equipment, faster movements, all of these things add little bits of efficiency here and there, which can bring your unit operating costs down and your per ounce operating costs down, and therefore your profits up. So the way that we model this resource is, even though the mineralization goes past 400 meters depth, we only model a JORC resource to 300 meters depth. We're very focused on bulk open pit, and we want to find the next bulk open pit along strike, as opposed to continuing to go deeper and deeper on sub 1 gram mineralization. We will always have the opportunity to continue digging that, but in terms of finding new stuff, it's a lot easier and cheaper to find shallow stuff. So when we look inside that 300-meter deep sort of pit boundary, there are 3 key characteristics that get interesting from a development economic standpoint. The first is that 80% of the tons and the ounces are within 200 meters of surface. So there is a slight sort of bias to shallow, if you will. And then right in the center of the deposit, and I'll try to, I'm not sure if you can see my cursor there, but just to the right of where it says 2.9 kilometers on the image on the left, we have a higher grade zone of mineralization, which is one of the first things that we drilled and validated. That's about 300 meters long, which is not really that big, but it is essentially a higher grade core right in the center of the deposit. So it presents an ideal opportunity to have or place your starter pit. And if you look at the cross section on the right of the slide here, that's a cross section of what that looks like. And what you're looking at there, for context and scale, is primary mineralization that's coming up in sort of like the trunk of a T. And then the top of the T is essentially a supergene sequence, which is what you see in light blue on the image on the left. But the trunk there in that T, what you're looking at is between 80 and 100 meters of mining width. So this is a football field long wide, which is a very big, very bulk orientation opportunity for open pit mining. And within that, in this central zone here, what you can see are some areas that are sort of orange and red. And so within this 80 to 100 meters, you have anywhere between 10 and 30 meters of mineralization that grade between 2 to 5 and 5 to 10 gram per ton in the block model. So this elevates and essentially creates a bias to the center of the grade in the model, and again is really ideal for a starter pit. And then, of course, looking at that supergene sequence, light blue on the left and that T zone on the right, this is between 100 and 200 meters wide, 10 to 30 meters thick. It runs the full length of the deposit, and it carries about 250,000 ounces in it. So we have shallow, softer mineralization running the full length of the deposit. So as you start your higher grade starter pit, and then you expand to the north and to the south to open the pit for bulk operations, you actually are getting paid for your pre-strip, if you will, as opposed to just having to fully pre-strip everything before getting into revenues. So that's very attractive. And the way this has all come together as an initial scoping study is to demonstrate that those three key features really do combine into something that can operate very efficiently at scale. So the working theory for us was that we didn't want to try to sort of size the project to aim for a 10-year operation and maybe go subscale on the capital and the economics. We wanted to test first, how does this behave at scale? If we look at this as a 5 million ton per annum operation, so something really in the vein of what Capricorn have done with Karlawinda, if we look at it as a 5 million ton per annum operation, how does capital cost relate to operating cost, and how does that relate to mine design and optimization? How efficiently can we make this run? And by the way, let's take some pretty conservative assumptions. This is a starting point. We don't want to overshoot it. We want to create a really strong baseline from which we can continue to move forward and optimize. And what that's come up with is a fairly advanced mine design. We had a lot of metallurgical and hydrology and geotechnical work and all sorts of analysis to bring into a scoping study. And it gave us a project that says, okay, this is a project that can produce 833,000 ounces over the course of about 6.5 years of mining and processing, or about 130,000 ounces per annum. We have also a nice byproduct silver credit of just over 300,000 ounces of silver per annum. But really importantly, what we're looking at here is an all-in sustaining cost of around $1,900 per ounce Australian. And to put that in context, if you look at, the industry is very big on showing cost curves. If you took an AISC of $1,917 today and plotted it in the quarterly reporting that a number of people do, including Aurum Analytics, is excellent research. If you don't subscribe for it, I recommend you do. That would actually rank Tunkillia on this basis number 17 of 47 Australian gold producers today in terms of the all-in sustaining cost, and therefore by the profit margin or the operating cash margin made processing gold. So that's a very compelling result. That drives a very strong IRR of about 40% and a very strong payback period of about 1.9 years, considering the scale of the capital that we've looked at here. But again, this is really a preliminary test, again, to define how do capital, operating costs, and mine design relate. Notwithstanding the fact that we've used very conservative results, this has given us very strong returns and a very competitive outcome. We're now going to be going and looking at capital costs, operating costs, and mine design to say, now that we know how these things work together and what the relationships are between them, what are the key targets for optimization? How can we tighten up some of our operating cost assumptions? How can we tighten up some of the capital cost, in terms of both cheaper pricing or greater efficiency in design? And then how will that actually help expand the mine design? Because if your processing cost or your operating cost is higher, it takes away the amount of money you have for mining and therefore shrinks your mine plan. So we're looking for opportunities to not only reduce the upfront capital cost, to not only reduce that process operating cost, but therefore to expand the mine design and see if this doesn't start to become 7, 8, and start heading towards 9 and 10-year style of operation. When we look at the design itself, we come right back to that starter pit concept. So the way that we have designed this, and this is really helpful to think about in terms of optimization as well. We've designed this in pit stages, right? And this is a very common design synthesis for open pit mining. Different pits and pit shapes will be dug at different times based upon optimization of the material in the pit, the movement of that material, and then also the nature of handling and processing that material. So we've designed this in sort of 2 pits in 4 stages, and we've got the area 223 long section on this slide. We also have an open pit at the area 51 deposit, but those pits are dug in essentially 4 shapes or 4 stages. We have currently about 2/3 of the resource inside these pits is indicated resource, and about 1/3 is inferred. But this high value starter pit, or I should say the starter pit, is very high value. So that area where we had that sort of high grade cross section we looked at a few slides back, this is a starter pit that yields 4.9 million ton of material, so about 1 complete year of mill throughput. And during the ramp up period, this is essentially feeding the first 18 months or contributing to the first 18 months of mill throughput. And you can see that below the long section there, represented as year 2 and year 3. So in year 2, the starter pit is feeding 100% of that startup feed at about half speed, or 2.5 million tons for that particular calendar year. And then year 3, it's about 50% of the total feed. And the other 50% is the main pit area below that starter pit. But that starter pit, essentially, because of that higher grade mineralization, has an elevated gold and silver grade. And so instead of a life of mine cash cost of about $1,874, and $1,874 is essentially the all-in sustaining cost minus the sustaining capital cost. So $1,874 is the cash operating cost for the life of mine, with a cash margin of about $1,600 per ounce. The starter pit is actually generating gold at a cash cost of just over $1,200 Australian, and yields about $2,260 per ounce cash operating cost. So this is how, we have this one starter pit that in 18 months essentially pays back the entire capital cost. And that's how we get this 1.9-year payback. So that starter pit has been exactly as important as we anticipated that it would be. And that gives us the sort of the base coverage to go out now and focus on expanding this and continue to add basically return and NPV and years growth by optimizing the design and costing of this project. So when we look at doing that, there's really a couple of key things that we're looking at here. And it really comes down to essentially the crushing and grinding, or the comminution circuit, and the power required to do that. So there's 2 kind of helpful images on the right-hand side of your slide here. And these are essentially the process cost component of operating costs. So generally speaking, you have processing costs and you have mining costs as part of your operating cost bucket. These are your majority components of these costs. When you look at processing costs, what you can see is that in the entire process circuit, grinding is nearly 2/3 of the process cost. We have started with some fairly conservative assumptions, we believe, around the nature of crushing and grinding. One, we have only assumed a single stage crush as opposed to a 3-stage crush. So we've assumed a single stage crush, essentially dumping very large pieces of rock into mill. So essentially the crushing is single stage crushing to 150 millimeter or 15 centimeter going into a 2-stage milling cycle. But we've also assumed that the rock hardness for crushing and grinding has a bond or ball mill work index of about 25 or 26. And that's very high. What we did is we took, of all the historical test work, we took the worst figures from a very small slice of the deposit area, which was actually a mafic dike. It's not something that actually is really gold bearing in any sense, but it by far has a much higher work index, and it's only about 1% of the mill feed in the whole mine design. But we applied that hardness to all of the material. And in reality, we might see that the weighted average bond to work index and bond rod mill work index are more like 20 or 21. So if we're putting really large rocks into a mill that are really hard and take a long time to grind, what it means is you need to use much, much more power, and you need to have a much larger mill to accommodate that throughput and to grind it down. If in fact we are correct and we are able to sort of formulate and strengthen our assumptions around the hardness of that material, we can possibly lower the amount of grinding required, both with additional crushing and the fact that the material is in fact softer. That would require a smaller mill for the same throughput. So we can look for optimization in these simple things just by looking at those key components. And the real key takeaway there is how much power is it going to take to crush and grind? The image on the bottom shows you that while grinding is about 2/3 of the cost of processing by cost center, power is the actual number one input by actual cost component. So pulling that back and having softer material could make a significant contribution to actually further lowering our costs and then extending the resource. And there's a whole host of other things that extend from that in terms of lower consumables and other operating efficiencies.
Alex, if I can interrupt there's a couple of questions, if you don't mind.
Yeah, absolutely.
Just going back a step and looking at your register, you've done particularly well attracting some institutions on a relatively small market cap. Now, you're in Geneva. How's the interest in Geneva?
Yeah, so we have been very fortunate attracting good institutional support, and I think that's really the groups that are on our register are groups that have sat and watched us for quite some time after we became a public company, and in fact, most of our institutional participation here is comprised of groups who, after certain key steps moving forward, came forward and said, "Look, we really like what you're doing." We like the consistent progress. We like the good communication. We like the fact that you're not diluting the register very much doing all of this. Of course, they like asset monetization because it doesn't require them to fund everything. So we've only actually done 2 small capital raises since we IPO'd 3 years ago, and both of those were essentially responsive to conversations with funds saying we'd like to take an initial position and build on market, and then we'd like to top up. So that's been a strong strategy for us. It's gotten us very strong alignment. We have a number of investors in Europe, UK and Western Europe, including Switzerland, France, Germany. So I am here currently meeting with some of them to go through some of these conversations. But it is really interesting when you look at how the market is evolving right now. Obviously, there's a lot of conversations about the gold market, what's happening, monetary policy issues, geopolitical issues. What we find is that in Western Europe, the sort of the attitude or the sort of degree of sophistication in thinking about gold on a much longer term horizon is pretty sharp. So we're getting a lot of interest from groups who are really, really keen to sort of say, look, we see this on the path to a successful delivery, and now is the time we think that we want to step in and be a part of the story. So it is very interesting that I'd say the temperature has changed fairly dramatically in the past 12 months, and certainly the past 6 months with gold sort of consistently testing new all-time highs.
There's another question here. It's a rather long question, but it's talking about the study capex and its impact on the share price with the high capex perceived to be unachievable. They've spoken for you how you've explained that well, but how do you go about convincing the market that the capex is achievable and hence gain improvements in sentiment and market cap and your kind of time frame around that?
Yeah, so I think there's a couple elements to that. One, we've taken a very conservative approach with the CapEx. So we have assumed that the majority of the capital is delivered by an engineering procurement construction contract, so EPC. So in terms of the upfront infrastructure cost, it's about $374 million. About 70 of that is EPC costs. So, and obviously that includes some costs around engineering and these types of things. But we have also sort of looked at sort of indirect procurement, again, looking at assumptions, or so we think conservative assumptions around the crushing and the grinding. These mills are much, much larger than they would be if, in fact, the material is softer and is passing through faster. So we think we have ability to bring in that capital cost fairly significantly by optimizing these things. But it is also important to think about sort of the other end of what we're doing here is as we are shifting costs down in terms of capital and operating costs and extending the mine life by saying we give ourselves more budget effectively to extend the open pit resource. What we're hoping to achieve is to bring that the OpEx and CapEx down, extend the mine life, and then it really becomes about the ratio of capital generated versus capital invested, right? So the return components of the analysis. Now, that 40% IRR that we've generated, even though it's only a 6-year operation, that 40% IRR on an unlevered basis demonstrates how strong these economics are on an annual to annual, a year to year or per annum basis. So as we can extend 1 year onto the next, this becomes much, much, much stronger, both in terms of NPV relative to CapEx and then just overall return. So this is why we're focused on marginally increasing the current resource here and also going in and bringing in additional resources regionally that can come in as blending feed. So I hope that's a helpful, more sort of comprehensive analysis here. But even from the financing standpoint, the reality is the market's interested to finance things that it is confident will be built. So we are interested also in making sure that that capital is not only financeable from the unit metrics of the project, but that the company is also in a stronger position by the time we get there. That's why we're focused on using our existing mill to leverage smaller scale operations. If we're just producing 20 or 30,000 ounces per annum from our existing operation with an existing mill, suddenly we don't have a piece of ground, a pile of components, and a promise to a bank. We have an existing facility next door at standpoint. Long story short is we intend to re-rate the company by restarting stage 1 operations with the existing mill and smaller, higher grade feed. And that will re-rate equity, re-rate credit, and make it a lot easier to raise the component of capital that we need, but hopefully actually reduce the capital required from an equity standpoint.
Makes sense. I'll let you continue.
Great. So everything that we've looked at with Tunkillia here, for context, is just in the little green box that you see on this slide. So again, we have over 20 kilometers of untested shear along strike. And what we're hoping is that we can find multiple repeats of this sort of key deposit area that we've currently modeled and essentially turn Tunkillia into a district of bulk open pit mining operations, feeding this mill and turning this into a truly long life bulk open pit significant gold producer. And if you have a series of bulk open pits, whether it's just the ones that we've mapped currently or other future extensions along the shear, you would love to have some high-grade gold nearby because this can act as blending feed and essentially considerably increase the annual economics of operation, such as we saw in our starter pit, where the average grade went from 0.9 to 1.2, but it had such a dramatic impact on the profitability on a per ounce production basis. So this is where we then step back to the north, and now we're looking at Tarcoola. So again, just to the north, 70 kilometers of Tunkillia. This is at the heart of Australian rail infrastructure. So we have the Sydney, Adelaide, Perth rail and the Darwin rail passing right through this project area. And this is where South Australia actually had its gold rush in 1893, the same year that West Australia had its gold rush. In the southwest corner of our exploration licenses there, where you can see the labels Perseverance in the Western Target Zone, this is where the old timers came in and were mining sort of narrow, high-grade veins sticking out of the ground at grades of 30, 40, and 50 grams per ton. 100 years later, a small mining lease is put in place. That's our mining lease 6455. And the open pit Perseverance mine was dug. So that's the one that you saw on the cover of the presentation. Now that pit was dug around some of these historical high grade adits, and it was producing grade at an average grade of 3 to 4 grams per ton to our Central Gola mill during 2017 and 2018. So we focused on two things. One, let's work out the geology that's going on around that pit and see if we can add some mineralization immediately in the pit floor that becomes very high value, because that's a fully licensed pit, a fully permitted pit that can go to a fully licensed mill. But two, let's also see if we can work out what's going on regionally. What created the over 600 shallow high grade workings across a relatively small area? It's about 10 to 15 kilometers long. What created that? What system of structures are there? And can we find more repeats of this pit? And to look at the pit itself, this is useful in thinking about our stage one strategy, but also why we're looking for more of these. This is a long section of that open pit, and what you can see here is actually it's a very shallow pit. So on the north end to the right, it's only about 30 meters deep, and on the south end to your left, it's about 70 meters deep at its deepest point. But this pit was probably produced around 35,000 ounces of gold. Beg your pardon, 35,000 ounces of gold in this relatively shallow pit. And we've now drilled quite recently through the pit floor, and we've added about 20,000 ounces in JORC resources right in the pit floor. And you can see these in sort of yellow, red, and orange shapes there. And that's all within 60 meters of the pit floor. So this is mineralization that's exposed, and we can quite literally dig this and take it to our mill at will. And this goes back to part of the question about how do we finance Tunkillia? Well, we have the ability to start operations with a fully permitted mine and a fully permitted mill. And now what we're doing is we're focusing on expanding this in-pit mineralization a little bit more. You can see there's a lot of areas here in gray that are modeled but unclassified mineralization. So not classified for JORC purposes. So we want to put 30 or 40,000 ounces on this pit floor, but that would then mean that this pit in the area immediate around it had a total historical mineral endowment of something like 100 to 150,000 ounces. So this is why we're interested in finding more of these. And this is where we then look out a little bit. So now we're stepping out, and what we're looking at is in a will sort of, if you will, a 3D shot, an aerial shot of what the ground would look like there across 10 to 15 kilometers if we were able to take a giant fire hose and blast away all the surface cover. And this is a map that we published in November of last year. While we were building Tunkillia, we spent about 2.5 years building our theory for what the regional geology looked like in this high-grade Tunkillia gold field. And our theory was that there were a couple of structures that were parallel to and cross-cutting the structure which hosted the Perseverance mine. And you can see that labeled there with a kind of an orange circle of where that is located. And there is a fault and a granite vein there that really host and control the majority of the mineralization. There are a few other orange circles on this map, and they highlight areas that are other areas where structures had just popped out from underneath cover previously. And these are areas where, again, the old timers were there and they were scratching at stuff, and where they scratched at stuff, it was high-grade gold bearing. Everywhere else in between these circles, the structures dive back under cover, and that might be 20 centimeters of cover or 20 meters of cover. But the point is that all of these structures have remained hidden. So we actually, this is quite exciting to us, looking at the area. It's the first time in the 130-year history of this gold field that you can actually see all of the known gold occurrences in a consistent structural framework. And what it also does, it gives us essentially a very significant target map to go through and see, can we find even just one or two repeats of this Perseverance mine area? Because if we can find another 50 or 100,000 ounce shallow high-grade deposit there, that's something that can have a profound impact on increasing the average blended grade of our Tunkillia operation and or feeding our existing mill. So we're currently wrapping up about a 9,000 meter program across this area, testing some of our highest priority targets. And during 2024 and 2025, we're hoping to help really crystallize that roadmap, not only to essentially the potential stage one operation, but then again, demonstrating to the market that this is going to come into a series of operations in exactly the way that will sort of make financing this sort of broader strategy much easier, going back to the last question. So We have been extraordinarily busy during the past few years. It is, when we put out a quarterly reports this morning, every time we write these things, we're sort of constantly surprised to be reminded how much we are doing with a relatively constrained budget in such short periods of time. 2023 and 2024 for us have so far been years of really consistent growth and progress. Going forward, we are going to be focusing really on, again, optimization of that Tunkillia study. That's going to include some additional drilling to see if we can smooth the resource, further smooth that pit design, optimization work around capital and operating costs, again, growing that mine design and extending the economics of the pit, but then also looking at Tarcoola to see, can we both find high-grade blending feed for Tunkillia, but also a pathway to stage one operations that helps us make that transition cheaply, re-rate us, and really start the ball rolling on what we think is going to be a really significant gold producer in Central South Australia for quite some time to come. So, by way of the obligatory summary slide, we have a very significant platform with the benefit of existing infrastructure. Importantly, we believe we are advancing it very consistently with leadership that is strongly aligned to actual equity outcomes for shareholders. We are very well capitalized today. With everything we've done over the past year, we still have $10 million cash on hand today. And we have quite a few things underway right now that we think are going to be significant catalysts and certainly strong general news flow. We focus very, very strongly on consistently communicating what we are doing and why we are doing it so that our shareholders understand that, one, we are constantly working for your investment and just as hard for your investment as you did. And two, that they can kind of see the pathway that we're taking and take comfort that we are consistently marching towards that strategy to develop a major gold producer. So thank you very much, and I'm certainly very happy to answer any additional questions.
Thanks, Alex. That's fascinating. There are some further questions. Just going back to Tunkillia, can you please discuss the findings from drilling at depth? In particular, how do you grade and ore body thickness? How does that change with depth?
Yeah, so when we look at the ore body at depth and on the main deposit area here, what you can see there are several different colors in the image on the left. So there's sort of 6 primary domains. And we haven't chased this to depth, if that makes sense. Obviously, you can see the shapes that we've modeled based upon the drilling that have been done. The way that we've thought about doing this is essentially going to a depth that we're comfortable modeling within, and then not exploring anymore to depth. When we do get to depth, we're still looking at widths of sort of 20 and 30 meters in a lot of these structures. So something that could still be mined to depth. But yeah, look, in short, we don't really look to depth because that's something that we'll consider 10 years from now when we're already standing on a pit floor and saying, hey, we still have 40 meters of mining width here. Maybe we could focus on going, another 50 meters deeper. The other thing that I might add to that is when we modeled this for the open pit mining, we imposed a minimum mining width of 40 meters. So even at our sort of max depth of 256 meters, I think in the main pit, which is by no means the deepest we'd be able to go with this in the future, we're still basically restricting ourselves to mining only stuff that's at least 40 meters wide. So the mineral width is quite strong there.
A couple more, if you don't mind. Is there any scope for improving feed grade with ore sorting that can contribute to reduced OPEX?
Good question. But in Tunkillia, we're broadly speaking, we're looking at a fine-grained, highly disseminated mineralization, except for in these higher grade zones. So it's not likely the case that something like an ore sorting with the Tunkillia resources, generally speaking, is going to be maybe a prime target for optimization there. But when we think about regional areas, so whether it's something else that we might find near Tunkillia or Tarcoola, Tarcoola mineralization is probably much more amenable in certain respects to ore sorting. This is where it's more complex geology. but you can see distinct differences in structures and granite vein hosting a much greater component of free milling gold. So that's something where we might look at ore sorting and then trucking down essentially a higher grade pre-concentrate for blending into that. But the real beauty of Tunkillia, in a manner of speaking, is its big base bulk simplicity. We want this to just be kind of constantly going through a bulk and then seeing what else can we sprinkle in from nearby that will take the year, the grade up to, 1.1 or 1.2 every year if possible, and produce 150,000 instead of 130,000 ounces per annum.
And just two more questions, if you don't mind. When will the
Mhm.
SE offset and Perseverance West mineralisation be converted to MRE?
Good question. So the southeast offset, if I look here, so southeast offset on this plan map, those are those two lines you see in the bottom right of the map. So we have drilled those and just sort of set those aside. We're actually getting ready to do a multi-element analysis work stream on those. And that's when we'll do kind of the full the full analysis of what's going on there, whether gold and any other mineralization. When we step away from the main deposit areas of Tunkillia, what we inherited was a very small or constrained work area in terms of data sets. So we don't have to step very far away before we're into very sort of new generative greenfield style exploration, and southeast offset is included in that. What we're looking at there is a prospective geophysical target. So we're working on setting up a multi-element work stream, testing that right now using XRF. Then we'll hopefully have those results out in the coming months. And then when we look at Perseverance West, sorry, I'll go back to the cross section here. So Perseverance West is essentially, if we look at it in a long section, we're sort of looking at the area to the south of the open pit of Perseverance, which is sort of in this yellow area here. But if we were to turn this image around 90 degrees or spin it 90 degrees, what we would see is that Perseverance West is a subparallel or second set of structures to the main structures that hosted the mineralization in that open pit mine. So we're still working on trying to understand exactly how you would model Perseverance West. What we're looking at doing, I think the low-hanging fruit is seeing, can we extend more of what's in and around these main structures here in the pit floor? And then how does this extend into depth? And then Perseverance West, we need to understand its relation to these structures so that we can try to model them both and convert both of these into resources.
And just one last one, and we'll finish on the hour, Alex. Any further asset monetization opportunities possible?
Yes, definitely. So since we IPO'd on the 28th of June, 2021. Since that time, we've generated over $10 million in non-dilutive cash for the benefit of shareholders through asset monetization in its purest form. So selling equipment that we did not need, or stuff that in some senses, in quite real terms, was junk to us and treasure to others. We've also done this by producing about $6 million worth of gold, and we've sold about $5.5 million worth of gold already, and also looking at things like renting our camps, and also using a state and federal funding programs. So we've done all this very successfully. We regularly rent our camps to groups working in the region. So we look to generate some regular money from that over time. But the big opportunities really reside in the other things that are sitting around. So we're looking right now at some of our stockpiles. We have both sort of bulk low-grade stockpiles, but also some smaller, higher-grade stockpiles, and also some other equipment that we just don't need that we're actually pulling out and cleaning up and getting ready to dispose of. So we'll continue to do that. We've generated kind of on average $3.5 million a year. And that in really simple terms has meant that the entire corporate overhead cost of the company is paid for every year through asset monetization. And in a funny way, it means that we invest more than 100% of our net cash expenditure into exploration and development. So we really are making the most of every investor dollar, and certainly are very, very focused on continuing to do that. because that is how we've had such small dilution. And obviously anything that we can do to extend this track record continues to protect and preserve value for our existing shareholders.
Right, Alex, we'll finish up there. Thank you for your time. Fascinating presentation.
Great. Thank you.
Thanks, everyone, for your time. We'll be back probably next week with another presentation. Enjoy your evening. Good night.